Someone who retired in his late 20s, I can tell you and I can promise you that all the people you know who have nice things, cars, houses, all that stuff, yeah, they're like two missed paychecks away from their entire life crumbling. All those nice things, yeah, they're all just monthly payments. Everything's financed. Everything's on debt. All of it. While it might look on the outside that they're doing extremely well and that they're so happy and they've accomplished a lot and they have a lot, in reality, they're just signing themselves up to work until they die. All just to maintain an image, too. A part of this is because Americans are impatient and insecure by nature, so they'd rather pay a monthly payment with interest now than save up and buy it in cash. But then, of course, unfortunately, there is a large percentage of the population that just doesn't understand how compound interest works. They don't understand how much they're actually paying for these things they finance. There are several people out there who rack up a giant credit card balance, make the minimum payment, and then don't understand why their balance isn't going down. Yes, I'm not kidding you, those people actually exist. The next time you see someone who you know, who has a lot of those things, just know that they're probably not doing as well as you think.
I hate to break it to you, but you might need plastic surgery. And I'm not talking about plastic surgery on your face or your body. I'm talking about the plastic surgery of what is in your wallet. I'm talking about your credit cards. You might just need plastic surgery on your financial life. And the reason why this might be necessary is that it will get you from relying on credit to actually relying on your own money and living within your means, back to acting and spending your wage. And over time, after this plastic surgery, your life can be beautified. So hello everybody and welcome back to my channel, and if this is your first time here, hello, welcome. This is Essential Patience and I Am Patience, and on this channel we have conversations about society's impacts on our lives and our finances and how we can take back that power and make more intentional decisions for our lives and put ourselves on a path towards financial freedom and financial independence. So if that sounds good to you, be sure to like this video, subscribe to my channel, and ring the notification bell so you do not miss out on any of my future videos. Let's delve deep into this plastic surgery topic. Credit cards, once a symbol of convenience, freedom, have become a double-edged sword for many individuals, leading them into cycles of debt that are difficult to escape. And for those on a debt payoff journey, choosing to close and cut up your credit cards can be a significant step towards achieving financial freedom. So in this video, we're going to be exploring the history of credit cards, the cycle of debt they often create, average balances, average interest rates, and the marketing tactics leading to overconsumption. And we need solutions, so I'm going to be talking about methods you can use to pay off your credit cards and how to stay out of credit card debt. So to really understand where we are in our history and economy with credit cards, we have to go back to the history. What are credit cards? Where did they come from? And how did they impact our lives? So the concept of credit has existed for many centuries, but credit card, as we know, it began to take shape in the mid-20th century. And if you don't know what the mid-20th century is, that's the 1900s. The first widely accepted credit card was the Diners Club card, introduced in the 1950s as a charge card used primarily for travel and dining. By 1958, American Express launched its own charge card. And in the same year, Bank of America introduced their card called Bank AmeriCard. Oh my God, that name just throws me off. I was like, is this real? Yes, it is. And that eventually became Visa. So after that, the 1970s and the 1980s saw a rapid expansion of credit usage as banks began to issue credit cards to broader audience. The rise of the internet in the 1990s further accelerated credit cards adoption as online shopping became increasingly popular. But today, credit cards are everywhere. They're widely accepted, with nearly 83% of US adults having at least one credit card. So that's a lot of people. And this is as of 2023, so that's basically everybody. But let's talk about the cycle of debt credit cards can create. And we can really see this by the balance of credit card debt. Credit cards can easily create a cycle of debt due to their revolving nature of high interest rates. As of 2023, the average credit card balance in the United States was approximately $5,733 per person, and this is according to the Federal Reserve. And the average interest rate on a credit card has been steadily rising and is currently around 20.68 APR. And that's a lot of interest, meaning that if you borrowed $100 at the beginning of the year, at the end of the year, you're looking at $120. And that's on a small balance. But imagine if you borrowed $10,000, then at the end of the year, you're looking at paying $12,000. Because of the high interest and the minimal payment that credit cards present to customers, it encourages them to pay the minimal payments, which barely covers interest, leading to them growing their credit card debt, spending more on a credit card they cannot pay off, and over time just accumulate so much credit card debt that they don't even know how they got into it and how they're gonna pay it off. An example of this is that you have $1,000 in credit card debt and your minimum payment is $20 per month, but your interest rate is 30.99%. You are not even scraping the interest. So not only are you increasing your credit card debt because you're more likely not spending, you're not paying nearly as much to even make a dent in your credit card debt, but then also your interest keeps increasing. So your balance is increasing. You're barely making a dent with your minimal payments. And at the end of the month, your balance would increase from the previous month. Now think back to when you got your first credit card. What made you want to get a credit card in the first place? And how did they draw you in? Oftentimes it's through marketing. Credit card companies spend millions of dollars to market to audience every single year. It is so much marketing that you can see on television, social media, having celebrity endorsements, all to convince you to get a credit card with them. I remember my first credit card was Discover, and the way that I decided on it was mostly because they had a secure credit card, but I used to see advertisements all the time, and there were some people in the financial space who also recommended it as a starter credit card. But my American Express is something I got marketed to, I think it was like at the airport or something, but I ended up signing up for it anyway, and I do not have any regrets on that one. But this is not the only thing that they do. They use sophisticated methods to market to you to get their credit cards and also encourage you to spend on them and to spend more than you otherwise if you were using your own cash or debit card. And one of the ways they get you to do this is rewards program. I was having a conversation with somebody who was like, oh yeah, but I get 5% cash back. Yes, sis, but you spent 95% of your money. So you're spending $100 to get back $5. Does that even make sense? In what world would I say, give me $100 and I will give you $5 back and it would be a great deal? It's not. So there's that gratification that we get from indulging in our purchases that we probably shouldn't be buying anyway, and then feel like we're getting points, we're getting cash back. And that is a trap. Spending $10,000 so you can get $10,000 airline points that would not even get you a ticket to the next state is laughable. But credit card groups spend a lot of money on market research to see what will get people to spend more. If I tell you to spend $100 and get 100 points, would that encourage you versus $100 and 10 points? Even though that 100 points might be equivalent to $1 when it's time to redeem it. But whatever gets people spending, that's what they'll try. Another thing they get you with is introductory 0% APR. And APR means added pain and regrets, according to Jade from Renzi Solutions. But its actual meaning is annual percentage rate, meaning what you're going to pay as the interest rate. So they'll tell you, oh, it's 0% for a year or 6 months. And then it gets you spending. So as you're spending money and building a balance on that, you're thinking, oh, I'll pay it off before the APR kicks in. And then it kicks in. And then all of a sudden you don't have the money. So you already have a big balance that you can't pay off. And then the added interest. Also, this is for balance transfer cards. So let's say that you have $5,000 in credit card debt across 4 credit cards and you decide to consolidate it and get one credit card for $5,000. They will tell you 0% APR for the next year, and you keep paying on it, but you don't end up paying all the $5,000. What some would do will backtrack it, and immediately you will have all the interest that was withheld put on your balance. So you could have made progress of, let's say, $1,000, but then if that interest rate is $1,000, you go back to having that $5,000. So if you do a balance transfer, know the rules and the regulations and pay it off as quickly as possible. Do not fall for the 0% APR and delay paying it off. And that's actually one of the reasons why a lot of financial advisors do not recommend consolidating debt, because even though it's a good step in the right direction, a lot of people feel like they've already done something because of the introductory APR in the first place, and then they don't pay off their debt as fast as they would had they been separate and had they been filling the interest. Another way they get you is those pre-approved letters. You've been pre-approved. If you've ever got that letter, know that you are not special. We all get them. There is this one scammy one. I'm not going to mention the name, but it is a scam. I'm pretty sure they've sent a letter to everybody across the United States of America, probably diaspora as well, to tell you that you have been approved, and they have horrible benefits. This is one of the cards where you get literally no benefits. Not that credit cards are like the greatest thing ever, but these ones are horrible. Let me know what your guesses are in the comment section. Let me see if anybody guesses. I'll probably end up liking that comment anyway, but they are horrible and they have really horrible interest rates. And they send this letter sometimes with like a credit card attached to it, like you have been pre-approved. And their name also sounds like a legit bank that a lot of people use. I actually have the Legit Bank's credit card. Some people fall for it. Let me know your guesses in the comment section. What credit card do you think I'm talking about? But they're a scam. Do not fall for them. So if you get these pre-approval letters, please know you're not special. They just found your name and they know your address and they're sending it to everybody. Sometimes your name is not even on there. It's just your address because they know somebody lives there. But one of the most effective is target marketing. A lot of companies are now pivoting towards targeting the people they know will have the best results. So people who already have a bunch of credit cards, they don't mind opening another one, or people who already have a history of debt, they'll definitely will open another credit card to spend more because they don't have enough money to pay off their debts. They will carry a balance, meaning that the company has the opportunity to gain interest from them. So these are the many ways that companies draw people in and keep them in a cycle of debt. And these marketing techniques is not just to get you a credit card, but also to get you into overconsumption and promote a culture of overconsumption, which is so easy because that's what our culture is today, unfortunately. But when credit cards get you to spend above your budget, spend above your means and what you can actually afford, that's where they make their profit, because they don't make a lot of profit from you paying maybe your annual fees. I have one credit card with an annual fee, and I know that they know that they can make way more money if I carried a balance versus paying it off monthly. But I would never give them that satisfaction. So let's talk about breaking the cycle of debt. What is the significance of having that plastic surgery? Sitting down and chopping up your credit cards, starting to live a life post credit card. What is significant about it? I actually think there's going to be a lot of benefits, because for individuals on debt payoff journeys, closing and cutting up credit cards can be a powerful symbolic and practical steps towards financial freedom. By eliminating the temptation to continue to use credit cards, individuals can focus on paying down their existing debt without adding to it. So let's go to number one, which is if you freeze your credit or you just close all your credit cards and decide not to open any new ones, then you're not accumulating any new debt, right? So you're not going to get a personal loan, buy a new car, payday loans. We're not talking about all of them. We're talking about credit cards. So you're not adding any new credit card debt and hopefully no other new debts. So because your debt is that one certain amount, you can focus on just paying it off. Because one of the hardest parts about paying off debts is if you're already adding a new one. So it's like, yeah, I'm paying $2,000 a month, but you're adding an additional $1,000 every single month, or even more, $2,500. Where is the progress? You're not making that much progress because you continue to add on more debt. And when you cut up your credit cards, you're also reducing financial stress immediately, because now you don't have to worry about going deeper into debt or feeling guilty when you do. Instead, you're going to be more likely to rely on resources, and it would just allow your mind to breathe and just be one less thing to think about. Or like, which credit card should I use? Which credit card do I have the least balance on? Which credit card has the most interest rate, so I don't use it when I'm going to get my daily coffee, even though you should be making coffee at home? So a lot of the stress can be eliminated just by getting rid of the credit card. And cutting up and closing credit cards just to pay them off can actually help you, because it would improve your credit utilization rate. When you decide to rather just pay them off, as the debt gets less and less, your credit utilization will also go down and it will better your credit score. Another benefit is that it changes your spending habits. Now you have to actually think, do I have this money in my bank account that I'm about to spend? And if yes, you proceed. If no, you probably want to stop, unless you want your card to decline at the cash register. But it encourages you to actually live within your means and only spend money that you actually have and have budgeted to spend. So now that we've talked about how we're getting marketed to, the history and the consequences, let's talk about how to actually pay off your credit cards. And I'm not talking about just paying the minimums. I'm talking about paying them off so that you become free of credit card debt. Number one is the snowball method. I always talk about the snowball method because it's one of the best methods for paying off debt, which is listing your debts from the lowest to the highest and then paying it off from the lowest to the highest. It's a snowball. So you start small and then you pay minimums on everything else. So it's not like you stop paying on the other debts. You're paying minimums on everything else, and then you throw whatever extra money you have on the smallest debt. And once you pay it off, and you pay it off with quickness, then you roll it up to the next one. So it's a bigger ball because now you have the minimum payment of your last credit card or your last debt, and then the money you were throwing at it, and then you're paying it off at this one, and then you roll up to the next one. Let's say you had debts that was $1,000, $2,000, $3,000, $4,000, and $5,000. You're paying minimums on everything, which is $50. So your minimum payments for the 5 credit cards is $250. You have an additional $500 per month to get your debt payoff going. So the first month you pay the minimums on everything else, and you throw $500 at this debt. And then the next month you pay another $500. So now this one is gone. Everything else is pretty much there, but you're paying the minimums. And so now you have 4 debts. So now you're paying minimums on the other 3. And then this one, you're throwing that extra $500 per month and the minimum payments that you no longer have to do to this one. You do that for 4 months. You're down to 3 debts. You throw the minimum payments plus the extra $500 onto this. So you're tackling it one at a time, and it becomes a snowball until finally you have no debts. It's really good because it tackles your behavior and you get quick wins versus the avalanche method where you're paying off the ones with the highest interest rates, which could literally be the biggest debt. So you don't get any quick wins. But with the snowball method, get the quick wins, and you're also eliminating debt after debt, and it just becomes quicker and quicker till you finally pay them all off. But the second method is the avalanche method, which I've been alluding to in the previous one, paying off the highest interest rates first, which is good if you're a person who actually just does things in facts rather than behavior. But most people get into credit card debt. It's not a math problem. It is a behavioral problem. And because it's a behavioral problem, you don't solve a behavioral problem with a math solution. You rather do with a behavioral solution, and that's where the snowball method really shines. But let's say you got into the debt because you went to school, whatever other reason, that was not behavioral, but rather just situational. The avalanche method could help you out if you're just one of those people who is into the spreadsheet, who's already into the numbers, who already knows that their behavior is not what's leading them into debt. Then the avalanche method might really help you. Another thing you can do is balance transfer. Now, I warned you about what could happen if you balance transfer and you don't do it the right way. But if you do, if I go about it the right way, you can take all of your credit card debts that is gaining interest, sometimes 15 to 30% interest rates, and put it on a 0% APR for say 12 to 24 months, and then pay it off as quickly as possible. This would just give you that extra room because the interest rate is not growing in those 12 to 24 months. But you have to be sure to pay it off. Do not, and I mean under no circumstances, do not just put it on one balance and feel like you've done enough work and not start paying it off. Attack it with vengeance and pay it off as quickly as possible. I helped somebody do a balance transfer, and I've been encouraging them, please pay it off, please pay it off, and they're almost done. I'm so happy. So it definitely can work, but a lot of people fall into the trap where they balance transfer and they do not pay it off all together, and they just carried on to another balance transfer card and another one, and it's been 10 years and they're still balance transferred. Come on, you all, something's got to change. But beyond balance transfers, you can also do a debt consolidation loan. I've seen this go right and I've seen this go wrong. You can take a personal loan of say $10,000, and if you have $10,000 in credit card debt, pay off all of your credit cards and just have that one personal loan. And this is often beneficial because for a personal loan, your interest rate might be like 10 to 12, maybe 15% versus credit cards where it's like 30%. So you're definitely getting that quick win. Just like the balance transfer, pay it off as quickly as you can. Do not get comfortable just because you feel like you've made a good financial decision and now you're going to relax and then accumulate more debt. Definitely do not accumulate more debt in credit cards. Number 5, which I've really been on, create a budget. Living life without a budget will always get you into sticky financial situations. How are you living life without a plan? How are you living and balancing your finances without a plan? It's very hard for most people to do it. Saving is not something that people do just automatically, at least not most people. So if you don't have a budget, you are essentially living life without a plan, and your finances will not be optimal. So create a budget, look at your expenses, how much money you make, and make sure you are living well below your means, or at least within your means. And within your means, I'm not talking about payments. I'm talking about paying things off and only buying things that you can afford, and most importantly, saving. And the last but absolutely the least is that if you really need it, you might need to seek professional help in 2 ways. One is therapy. If you're always buying things and impulse purchasing because you have a scarcity mindset, I used to have a scarcity mindset. I've worked on it, I've prayed on it, and it's getting so much better. But some people, it's so bad that they might actually need professional help. And for me, my scarcity mindset was not leading me to purchase a lot, but for some people it does. So they're impulse purchasing. That's when you actually need a lot of help. For me, it was like save, because you never know when the next check is gonna come. So I'm glad it's at least that one, but it's still not a healthy mindset to have. Seek professional help in that sense of therapy and a therapist if you need it. But the other professional help is if you need a financial advisor. Make sure that they align with your goals and where you want to be. But certainly seek that help if you need it. Sometimes if you're not strong enough to really hone in on your finances and you have to pay somebody a little something to help you, it's very much worth it, because if not, then you'll dig yourself into deeper financial hole. I hear people talk about how therapy is so expensive, and it is. But let's say you can spend $200 per month on a therapist that is going to help save you money from impulse purchasing. Would you rather spend that, or would you rather go on your shopping sprees and spend $500, $1,000 per month and digging yourself into a bigger hole? So yes, it's an investment, but that's an investment that would actually yield a better result than continuing to spend. And now that we've covered that, let's get to our last section: how to stay out of debt. Once you pay off your credit cards, how do you stay out of credit card debt? Because one of the worst things is paying off your credit cards, getting out of debt, becoming debt free, and then going backwards. So how do we make sure that we do not get back into credit card debt? One of the biggest ways is having an emergency fund. People say, oh, my credit card is for emergencies. No. An emergency fund is for emergencies. A credit card is not for emergencies. You might keep it around, but it should not be your financial safety net. Why is it your financial safety net when you can build a 3 to 6 month emergency fund? And as I always recommend, if your 3 to 6 month emergency fund is less than $10,000, at least try to get to that $6,000 balance. Because here's the thing, a credit card, you can't use it to pay your rent. If something happens, you lose your job and you cannot afford rent, how are you going to use your credit card to pay for it? You can't use it to pay off a car loan. You can't use it to pay off any type of major financial item, because some of them don't even take credit cards. Build up actual cash savings that you can use. For example, if your car breaks down and you need to go get yourself a new car, some places don't take credit cards. I don't think most places will take a credit card. But if you had a $10,000 saved up, all of a sudden you have money to actually purchase yourself a decent car until you're able to build up a car fund to upgrade if you wanted to. So be sure to look at your expenses, how much it costs to live per month, and then multiply by 3 or 6 and build a fully funded emergency fund. I like to do the 6-month emergency fund because I think that it is safer because of who I am, always on the careful side. So a 6-month emergency fund for me is ideal, but it doesn't happen in a day. So if you need to start with 1, 2, 3, 4 months first before finally getting to your 6-month emergency, do that. The next thing you want to do is use cash or debit. Personally, I would prefer debit. I don't like touching money like that. Money is, scientifically very dirty and has a lot of bacteria. So I personally do not carry a lot of cash, and you can lose it easily. I find that it's hard to trace using cash. So personally, I do prefer to use debit if I don't want to use credit. This will make it easier to track your expenses, know where your money is going. If you need to plug it into an app and see how your budgeting is going, that is something that will be very helpful as well. Cash or debit. Stay away from the credit cards if you really have a problem overspending on them. The next thing you want to do is limit your spending. You can do this by setting spending limits for yourself, but if you really have a problem, most cards allow you to put spending limits on them. So you can do this on your credit card if you choose to continue using them, or use it on your debit card. I know that I have a limit on my debit card, like I cannot send or use more than a certain amount of money per day. And this has been very helpful to me. I remember when I was going to purchase my car and I was trying to put down the down payment and it blocked it. This is way above your daily limits. And I was like, oh, I set it and I forgot. It had been about a year since I set it. So I decided to go back and change it, to call them and tell them to change it just for today. And then I was able to put down the amount of money for my down payment. The fourth thing you want to do is to regularly evaluate your expenses and your spending habits. Are all of your expenses necessary? Which ones are necessary? Which ones are not necessary? And how can you ensure that you're balancing enjoying life with not overspending? Track your expenses. Know exactly where your money is going. And if you do need those budgeting apps that would categorize it for you, those are very helpful. Or you can use a spreadsheet like I do and just record everything, no matter how small it is, just to ensure that I know exactly where my money is going and that I'm on track for my financial goals. And the last but absolutely not the least is to learn about financial literacy. I'm glad you're on this channel, and on this video watching, listening. There's so much resources on here and on the entire internet. You just have to sift through the good ones. And I can assure you, my channel is premium when it comes to financial literacy, but just learning about it and what to do, what not to do. And that's why I always share my experiences, that went good, bad, because I do not want you to make the same poor decisions that I did. I learn from other people's mistakes so that I can make new and different mistakes. So you can also learn from those other people's mistakes and learn from my mistakes. So you overall make better on average decisions than the rest of us did. And really, because I listen to financial literacy podcasts and other people, I do not have any like horrible financial decisions that I've made that I just regret so much. I do not live with that type of regret because I just learned from other people. And I'm happy that I don't have to go through the same struggles because other people have already gone through it. Why do I need to go through that? I want to go through different struggles and a different level of things that I genuinely did not know. So now let's bring this video to a conclusion. Credit cards, while convenient, have the potential to lead consumers into cycles of high interest debt that can be challenging to escape. And for those on a debt payoff journey, closing and cutting up credit cards is a critical step towards achieving financial freedom. Understanding the history of credit cards and the tactics used by credit card companies to encourage spending and the methods available for paying off debts are essential components to a successful payoff strategy. By staying committed to a plan, staying informed, and adopting healthier financial habits, you can break the cycle of debt and the chains and bondages of credit card debt and live a more stable and financially secure life. So with that, I'm bringing this video to an end. Thank you all so much for watching this video. Like, comment, and subscribe to my channel if you haven't already, and ring the notification bell so you do not miss out on any of my future videos. Share this video with anyone who you think will benefit from this type of conversation, and watch more of my videos. There's gonna be some here in a playlist as well that I'm sure you would enjoy. Leave in the comment section, have you ever had plastic surgery, or is this your sign to have plastic surgery? I look forward to your comments. Thank you all again, and I'll see you in my next video. Bye.